Absolutely. Good having you, Mr. Mistry. Thanks for joining in. Take us through the key highlights. I mean, what has led to the numbers that you've clocked in? But more importantly, what is the NI growth excluding the dividend income for quarter 2?
If we look at this quarter, the quarterly profits have also got boosted because of the dividend that we received from HDFC Bank. Last year, the dividend was received in the first quarter of the financial year. This year, the dividend has been received in the second quarter. So if you were to quickly summarize the results for the quarter, individual business was pretty much business as usual. If we look at the growth in the individual loan book after adding back loans that we sold in the last 12 months, then the growth was 23%, which is actually exactly the same as we had in the previous year when we also had a 23% growth. However, the quantum of loans that we have sold in the last 12 months is much higher than what we traditionally used to. So in the previous 12 months till September 2015, we had sold loans aggregating to 12,969 crores, which compares to a little over 7,000 crores in the previous year. So on a balance sheet basis, the growth looks lower. But having said that, if we add back the loans sold, then the growth is pretty much in line with what it was in the previous year. Spreads, if we compare it with September of 2014, have actually gone up marginally, very marginally. Last year, spreads were 2.29%. This year, in the first 6 months, spreads are 2.32%. So I would say spreads are pretty much the same with a marginal increase. Non-performing loans, again, not much change. In June, the gross non-performing loan number was 69 basis points. And in September, gross non-performing loan number is 71 basis points, which is really nothing to read into.
Right. Mr. Mistry, we did see largely stable margins and spreads. In what range do you see the margins and spreads, especially in light of the recent cut in lending rates?
See, lending rate reduction is effectively a function of a reduction in the funding cost. So as funding costs have come down, so also have lending rates come down. Spreads remain unchanged. So if we look at the fact that we've reduced our lending rates by 0.25%, that is a function of the fact that our cost would also have come down by that extent. Incremental cost obviously has come down much more than that. However, the balance sheet cost has not come down sufficiently to reduce interest rates further. My sense is the reduction in the interest rates or our prime lending rates, which we did earlier in the month, will have no impact on spreads going forward. Hopefully, with the passage of time, as incremental costs keeps coming down, spreads would hopefully improve. As spreads improve, we'll pass the benefit back to customers by lowering lending rates.
While retail NPAs are stable, Q2 non-individual gross NPA rose a little bit. What has led to this increase, and what are the key trends that you're observing here?
Yeah. So to the best of my knowledge, in June, the non-individual NPL was 1.06%, not 1.04. It was 1.06, and 1.06 has become 1.12. Now, a 6 basis points change in NPLs in one category really doesn't mean much. If we look at the gross non-performing loan level, in June, the gross non-performing loan number for both categories taken together was 69 basis points, and in September that number is 71 basis points. So 2 basis points, one out of the 2 basis points can theoretically even be a rounding off difference. So there's virtually been not much change in the level of non-performing loans.
Right. So can we see higher disbursements and loan book growth in the coming quarters from the retail as well as non-retail segment?
See, if you look at the mix in our asset profile or in our loan profile between individuals and non-individuals, individuals now constitute 73% of the total loan book, and non-individuals constitute 27% of the loan book. If we had looked at this number a few years earlier, individuals would have been 65%, non-individuals would have been 35%. So clearly over the last 4 years, the component of non-individual business as a proportion of the total balance sheet has come down. My sense is this is a function of the investment cycle. As I mentioned earlier, my personal view is that given the macro dynamics of the Indian economy today, it is only a matter of time before we start seeing a pickup in the investment cycle. And as the investment cycle picks up, the demand for commercial real estate in India will increase. And when that happens, the component of non-individual loans as a proportion of the total lending could go higher. But it's difficult to give you a timeline or difficult to say in which quarter that would happen.
RBI has recently reduced the risk weights for individual loan books. How much savings do you see on capital front due to this? And also, will this lead to further reduction in lending rates, Mr. Mistry?
All right, so let's talk of the capital. On 30th of September, our total capital adequacy stood at 16.1%, of which Tier 1 capital stood at 12.8% and Tier 2 capital stood at 3.3%, giving an aggregate of 16.1%. In calculating this capital adequacy of 12.8% Tier 1, what we have done is that the investment that we have made in all our subsidiaries and HDFC Bank is reduced from Tier 1 capital. If the investment in HDFC Bank was treated as a 100% risk-weighted asset and not a reduction from Tier 1 capital, then the Tier 1 capital ratio would increase by about 2.5%. Now, the reduction in the risk weight on housing loans has been effected from October. So, in the September results that you are seeing, it is the capital adequacy is calculated based on the risk weights that were prevalent at that time, which is before this reduction. The reduction in the risk weight will improve or increase our Tier 1 capital by 100 basis points, that's 1 percentage point, and our Tier 2 capital by about 30 basis points. So all in all, capital adequacy will increase by about 1.3% after this revised risk weight takes effect, which will happen in the December quarter.
So the board has also okayed, Mr. Mistry, a sponsored ADR issue of up to 10% of the company's shares, and this is via conversion of existing shares. Tell us more about this. What was the thinking behind this?
All right, so what SEBI has permitted now is that Indian companies, that depositories, global depositories, can create a level 1 ADR in respect of Indian companies who do not have an ADR program. What that means is that there are several depositories globally. So you have a Bank of New York or a JP Morgan or a Citibank or a Deutsche Bank, amongst others. So any depository or any group of depositories can go and create a depository program for Indian companies. So that is what would be called an unsponsored ADR, which means we have no control over what they do. A depository can just go and create a depository platform where a HDFC share can get converted into ADR and traded over there. So that is what is called an unsponsored ADR. So rather than have an unsponsored ADR, we thought we should have a sponsored ADR, where we will have one depository whom we would identify. We would appoint that depository, and that depository will then create a ADR platform for us. It's a level 1 ADR. A level 1 ADR means that the shares of, for example, when we participate in that program, HDFC shares will get converted, or certain percentage of HDFC shares, as would be agreed by the board, could get converted into ADRs, and the ADRs could be subscribed to by investors who today cannot subscribe to these shares. So therefore, it opens up a new pool of investors for the shares. Level 1 ADR does not entail the issue of fresh capital. I think it's very important to understand that. There is no fresh capital that will be raised. It's just a conversion of some portion of the existing shares from a local share into a depository receipt, which will be traded on a over-the-counter platform in the US, and that's what is called a level 1 ADR.
Okay, and lastly, Mr. Mistry, when do you see Standard Life hiking the stake to 35% in the life insurance biz? It's spoken about a lot, and when can we expect an insurance IPO? I think that's the most important question.
So Standard Life had the option to increase their stake in the insurance business from 26% to 49% as per the shareholders' agreement that we had with them. But ever since the foreign ownership limits in insurance were opened up in February, we've had a continuous stream of discussions with Standard Life, and in the end, Standard Life have agreed to give up part of their option. So Standard Life will increase their stake in the insurance company from 26% to 35%, and they will not go beyond 35%. That then creates a platform for doing an IPO in future. There is under the IRDA rules, there is a definition which has now been prescribed for what is an Indian owned and controlled company. There are minor changes that are required in the shareholders agreement with our partners, which have been broadly agreed to between us. Those changes will be made in the shareholders agreement, and we will hopefully get the necessary approvals from the regulatory authorities, under which Standard Life will increase their stake from 26% to 35%. Once that transaction is completed, we will then look to file for an IPO. So our sense is that an IPO would happen sometime in 2016.
All right, Mr. Mistry, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.